Here it is.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld, PSW, nor its affiliates, nor any of the respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, let's see. How are the markets doing? We're poking back up. Look at that, look at that. Barely red, and barely red. Okay, and that's not the Russell, that's silver. Hey, silver was our trade last week, and I might have lost track of where we started, but it went pretty much according to plan. We see if I can get a longer chart of silver. Hang on a second. Came out nicely in the end. So, I mean, we're up. Oh, how do I get rid of this? Oh, no, that's not what I wanted to do. No. Oh, my God. Never did that before. I really broke this thing. There we go. Okay, good. Had to shrinky-dink this thingamajig. Where was I saying? Oh, yeah, so we ended up on 3 contracts total. There were $4,000 in profit. So where did we start out last week with the silver trade? Nope. Charts. There you go. So if we look at what happened to silver in the week since we've done the webinar, I think it was Thursday last week, the webinar, right? So this is a weekly chart. We don't want that. We want a 5-day, 15-minute chart, let's say. And here was Thursday. Okay. So remember, we liked silver when it was down at, is this the right day? How can I tell? Well, I have to imagine Friday, Thursday. Anyway, we liked silver down here, but we said we were going to go through a cycle and double down when it got lower. So it went from 1640 to here, where we added, we doubled down here. That gave us an average of somewhere in the middle, and when it went back up, we went back to 1. Then it went down again, and we doubled down again, and when it popped back to here, we went back to oh no, I'm sorry, I take that back. So we went back to 1, then on a small dip we went back to 2, but then down here we went to 3. And anyway, so the average came down somewhere around 20, maybe 26 or something like that. And now it popped to 40, and that was a nice profit, so we took it off the table. But you see, even though it's lower now than it was last Thursday, we still made money because we planned on adding to the contract and lowering our basis on the way down. And we don't need it to recover all the way because, see, here's the thing. If you enter here and double down here, skipping the middle part, but if you enter here and double down here, where's your average? Your average is right between the 2. And that means all you have to do is recover to the halfway point, and you're going to be even, and then above that, you start making money. That's the power of this. And we're talking about, that's a pretty big swing in silver, too. It went up and down quite a lot in the time that we've been playing it. So that's the advantage of sticking with these trades and having a plan like that. But you know, it's a little tricky. It's not, I'm going to say it's easy because you got to watch yourself. At some point, we're down a bit. But if if you move in and then get back out and then get back in and get back out, you just keep lowering your basis and grinding it down. That's the real key to this thing. But you can't just do it randomly. You have to have a good reason for what you're doing and trade with a bit of conviction. So yesterday the dollar was spiking higher and silver got pushed lower, and as far as we could tell, that was the only reason silver was lower. So we said, hey, maybe it's a good time. So we didn't blame silver for the loss. Well, it seemed like there was nothing wrong with silver other than the dollar going up, and since that eventually stops going up, it makes for a good trade on the recovery. All right, so meanwhile, let's look at more charts, not those. Oh, come on, short charts. So meanwhile, everybody's kind of bouncy, but not very exciting. I mean, we're not even making yesterday's highs right now, so we'll see what happens. Oil weak, but not terribly weak. In fact, earlier I said it's probably going to bounce off 67, so it bounced all the way back to 67 over 67.50. Gasoline, I said would bounce off 205. It never really hit 205, and that bounced up. And now natural gas is back at 280. It's still not low enough to really get excited about getting in here, though. Where's coffee? Coffee. There's no coffee on this chart. Okay, something's got to be. Brent, gold, silver, dollar. Who's going to go? Okay, well, we're not trading silver right now, so let's take a look at coffee. KC. Oh, and by the way, of course, we took a non-greedy exit on silver. It's at 1640. I was like, fine, that's enough. It went up a little bit after that, but then it came back down below. Coffee blasted higher. So, this is where we usually like to get in, around 118, 117, 116. And it has hugely gone up, and now it's finally coming back down. So now we're hoping we get back below 120 and we can get in again. So that's what we're looking for at the moment. Let's see if we got any questions. Sri says, can you give an overview of Bud and Tap and Yum? Oh, yeah. I don't think those are all big, complicated companies. So, frankly, that's going to take time. So you have to ask that in chat. I can't spend, I can't do a half-assed answer. It's not, none of them are stocks that we really pay a lot of attention to. They're all huge companies, and to give you a serious answer would take at least 15, 20 minutes of research on each company. So that's where we are with that. Apple had great results. Lerner says, assuming you're not recommending a new entry here, what price point does it have to drop to initiate a bull call spread? Okay, that's interesting, because we do have it, so let's talk about that. Are you still long NGV8? Yes, I am still long NGV8. That's a much longer term play, so I don't tend to get in and out of that one. If they super spiked, if they hit like, if they shot up to 3, I'd probably take it off the table and then see if it pulls back. But below 3, I'm very, very confident it's going to get to 3 eventually. In fact, it's so hot in New York, we had to put on air conditioners today in New Jersey. It's like 85 degrees already, and that's pretty hot for this time of year. So if we're going to have a long, hot summer, that's going to be a lot more electricity production, which is still mostly natural gas. What were we talking about, though? Apple, right. Apple, very important. So we were actually hoping it would do worse because we wanted a chance to buy more. In the long-term portfolio, I think we have nothing. Nothing. We have no position whatsoever in Apple. We don't even have short puts. I think maybe in the short-term portfolio we have some, though. We sold them as an offset. Is that correct? Let me see. Short-term portfolio. Apple. So all we did was sell 5 145 puts, and we sold those to pay for some other spread, and they're already up nicely. What was that in the long-term portfolio? 17.6%. Holy crap! It's a big number. 588. All right, so we're up 17.6% in the long-term portfolio without Apple. We'd like to get Apple. It's not in the money to our portfolio. I don't think it's in the OOP. Yeah, same thing. We sold some puts. So in both the portfolios, we sold some puts, but we don't have a position. Now, the question is, you got to think about it in the broader sense of it. How much should Apple be? APPL. So they're making what the AAP? Wait, that's better. Okay. Well, that doesn't tell you what they're worth. I mean, let's look over here and see what we can find out. Okay. What the hell? There we go. All right. So we're talking $900 billion valuation. So the next headline you see for Apple is going to be it's crossing a $1 trillion valuation to become the biggest company in history. They're making probably $55 billion this year. So the PE is still below 20. They're also buying back 100 billion. These are staggering numbers. I mean, these numbers. If you had said these numbers to me when I was starting out in stocks 20 years ago, you know, in the year, you know, in the 90s, basically, for however long ago that was. But in the 90s, if you had said to me, we're going to be talking about Apple or any company, GE, it wouldn't have mattered what company you said. If you were saying that they're going to buy back $100 billion worth of their stock. No, I know company was even worth $100 billion back then, and they were going to hit $1 trillion market cap. I would have said, no freaking way can that possibly happen. These are insane numbers that we are now dealing with. So meanwhile, they're not cheap. The PE is about right, 18. Even if you have good expectations of what they're going to do, you're still going to struggle to get to $60 billion. So these are funny words. You're still going to struggle to get to just $60 billion in earnings. There's only like 30 companies in the entire world that have a market cap more than Apple earns in a year. Oh, it's so crazy. All right, maybe 50 companies. And they're buying back 100 billion of their own stock. So the bottom line is, if they're buying back 10% of their own stock, then this PE drops by 2. So it's going to be 1.6 right there. Then you factor in a little bit of growth, let's say 5% growth, and you're dropping in another $1, basically. So now you're at 15 times earnings. And if you give them a little bit of growth beyond that for the next 2 years, you're talking about dropping them to 15, 14 times earnings. So again, although not cheap, it's certainly not expensive. They're still making the money, and they're buying back their own stock. They think it's cheap because they're buying it back even at this price. Usually I get really pissed if somebody does something like this, but they just repatriated $250 billion from overseas, and they're only using 40% of it to buy back their own stock, and the rest is just going to sit in the bank, until they decide what they want to do, like, buy Qualcomm. Whatever. I mean, Qualcomm's whole market cap is probably less than 100 billion. Let's see what they are. Yeah, $75 billion. So Qualcomm, they can buy Qualcomm for cash. They can just basically take some of their cash and buy Qualcomm. But they wouldn't, because Qualcomm doesn't make enough money. That's the funny thing about it. Apple's in a weird position because nobody makes money like they do. So anybody they buy is going to be a hit to their bottom line. Even a great company like Qualcomm, for $75 billion, Qualcomm only drops $2.5 billion to the bottom line. And even if it was $5 billion, their PE is still higher than Apple. Oh, that's a weird earnings too. What do they do? A little lower here, same R&D, same SG. Oh no, look at SG&A shot up. Wow. See, so that I want an explanation of. I want to know what the hell they're doing. Quarterly. Yeah, they've massively expanded SG&A. It's even worse than it looks, because that's quarterly. They're $2 billion. About you burn $2 billion a quarter on SG&A. The frick are they doing? Are they Tesla? They're making little Model 3s apparently. Wow. No, I don't know what's going on with them, but I wouldn't play. Anyhow, so it's very hard for Apple to find a company where buying them is a good use of their cash, because you don't want to buy somebody if you're making, like on Apple, you're making a buck for every $15 of the company's valuation. That's where Apple's at. So if they go to someone else and that person's making a buck for every $20 of valuation, then they're not making good use of their money, because they're better off sitting on their own stock, which is what they're doing. So Apple's not cheap but not expensive. So given that, if I was going to play Apple, and I guess we're going to have to at some point, I suppose we'll have to look for a reasonable spread. So, sorry, a trillion. So a trillion is going to be 10% more than where they are now. Got to keep the store price. So many things, balls in the air here. You got to keep it track. Oh, why do I keep doing that? AAPL. All right. So 176 plus another 17 is 180, 190. So basically, it's going to be really hard for them to get over 200, because when they get to 200, people are going to start freaking out about $1 trillion. That's a nasty, huge number. So I don't think I'd be betting them to go much higher than 200 in the near future. But that is, certainly I think by here they should justify it. But the question is, so what kind of spread would you want to have on Apple, given that they're not going to go much over 200? They'll probably get rejected there. So we can sell the 200 calls for $13.20. We can sell these for 12, the 205s. We can sell the 210s for 10.30. So do I really want the 200s? No, it's not the 200s, sorry. The 200s pay $13.20 and these pay $10.30. So for $3 more, I get $10 in cushion. I think I could live with that. So let's say, for argument's sake, what if we got the 160s? Those are going to be $32. 32 minus 10.30, that's a lot. 160, 190. Is that the 190 or the 195? 195. Okay, I can deal with that. That's a $35. That's a $35 spread. All right. So I would take the 160, which are $35. The 160s for 35. Wait a minute. Sorry. The 160s are $32. The 195s are more than 15, 20. So for 14 80, let's say, roughly. The 160, 195 spread. So that's a $35 spread for $14. I think I would go 20 long and 15 short. So that's going to leave you the 20 long and 15 short are, math is incredibly annoying math. Hang on. I'm making it way hard on myself for no reason. Are you kidding me? My phone doesn't have a calculator like right on top. Calculator, okay. Stupid iPhone X, right? So what did we say? We said the 160 calls, which are 32, so 32 times 20, 64,000. We can remember that. That's the $64,000 question. And then 15 times 1520 is 22,800 minus 64, 1, 2, 3. So the cost of this spread is $41,200. But I would immediately, though, sell five June 175s for 2,500. So still nasty though. Still $40,000 cost. Of course, you can do 1/10 of it and spend $4,000. But for $40,000, because you're knocking this off, it's actually 39,000, a little bit, 38 and change. But for 38 and change, you've got the spread. If Apple fails 175, you sell five more and pick up another 2,500 bucks. If Apple goes higher, you roll these to a higher strike in July, September, whatever. But the point is you have five longs that are uncovered, so you can keep rolling your short calls along. If it goes lower, you'll sell more and put a stop on half. And the idea is, in theory, if we have 600 days to sell and every 60 days we pick up $2,000, that you'll be able to knock your $40,000 cost basis down to 40,000 less. What did I say? 2,500. So basically, like, you can knock your basis down to like $15,000 on a what do we say it is? 25, 35 on a $70,000 spread. So that's the way I'd work into it. And I think we might try that in a long-term portfolio because it's a good strategy. And here's what you do. So you don't forget, though, it's very important. You're laying out close to $40,000. It's a $70,000 spread, but it's a $70,000 spread that's half in the money. And you have an excellent platform. You're partially uncovered, so you have an excellent platform to generate an income. There's no way that you can't sell $2,500 worth of Apple somethings a month. So you're really making, it's kind of like buying a house now, and you know you'll get at least something back, right? So in this case, you know you're going to get almost certainly out of your $40,000, you should be getting $25,000 back. So you're really only risking $15,000, because come hell or high water, we should be able to sell Apple short calls. And because, again, you're uncovered, that's why it's so expensive. But because you're uncovered, there's no situation in which it can burn you. And anytime it doesn't burn you, so let's say Apple drops for some silly reason, like let's say the whole market drops 10% and Apple drops 10%. Well, you take the money that you got from the short sale, and now you say, I got these 160s that are 32 bucks, and it costs, and these guys are 36 bucks, the 150s. So for $4 for $8,000, you can roll everything down $10, and that's going to widen your spread and put you deeper in the money. And then you just keep going along the same pattern. But if every few months you take 2 of the months that you sold and put it into widening the spread, you can make your spread $20, $30 deeper in the money, as this thing plays out. And then if Apple does hit our target over time, we'll be in fantastic shape. All right, so I like this. I'm going to do it in the long-term portfolio officially. I'll write it up tonight or tomorrow. But it's a good way to play Apple, and it's a good way to generate income. It's practically a butterfly play. This is how we do things in the butterfly portfolio, but it's a little volatile for the butterfly, so I'm just going to do it in the long-term portfolio. It's not even, unfortunately, something I can put in the short-term portfolio just because the stock's so freaking expensive. But in the long-term portfolio, like I said, we can knock the basis down to $15,000 and collect $70,000 or more when we're done. So, you know, why wouldn't I do that? That's 10% of our whole portfolio we can collect in a year. Oh, sorry, in 2 years. And look, they go all the way out to June 20th, so I'm going to have to look at these now, too. We can go all the way out to June 20th. I mean, June 2020. So that's kind of fun. How much are these 160s? Yeah, why wouldn't I, right? Look, these 160s, you know, and there's a trick, too. These 160s are 32. These 160s are only like 34. So for $2, you get 6 more months. And that's 6 more months that you can sell calls and make $2,500 every other month. So I'm gonna spend $2 times 2,000 contracts is $4,000. So I'm gonna spend $4,000 to put myself on track to collect $7,500 more dollars. Plus, I give Apple 6 more months to go higher. That's a no-brainer. That's the nice thing when you're in the money. It doesn't cost that much to roll out for time. So I got to evaluate all these also and see what the best contracts are. But that's conceptually the way I want to play it. You have Apple in the BNN portfolio. I do? Oh, okay, cool. I can't change that, though, because I got to be on the TV show to change it. That one I think is a pretty static play. Let me see. Unfortunately, they haven't scheduled me to come back on there yet. Maybe they lost interest in me. So where's Apple? See, here we just have a straight layout, though. Here we've just simply got the 150, 165. That's a boring spread. So we're totally in the money on that one. We have the this year January 150, 165 spread with the short puts. Here we spend 50 minus 35 is 15 minus 9 is 6. We spent $6,000 on a $30,000 spread, and that's going to pay off. And currently, it is 22 minus 2 is about $20,000. So it's a what? It's a $30,000 spread. Yeah. So basically, it's roughly it's got about 50% more to go. So this will make another $10,000 by January, which is crazy. I mean, this was only a $50,000 portfolio. So if you think about it, that's 20% of the portfolio we're going to make between now and January on a spread that's already deeply in the money. In fact, I mean, anybody can take the spread right now, and it's going to pay you 50% on your money. That is nuts. But that's why options are great. I mean, people just don't realize how fantastic options are, and especially if you play them conservatively. And that's the problem. Most people don't play conservatively. But that's what the advantage of what we say is being the house. People want to take huge risks. They pay big money to take risks. Take their money. Don't be the guy taking the risk. Be the guy who says, okay, I'll take this completely in the money spread on Apple, where my only risk is owning Apple at $140, and I'll pay net $20,000 for it, and it pays off $30,000 if Apple holds 165 for the year. It's not a big risky play, especially now that you've seen earnings and all that. Sure, the whole market could tank, but what's your worst case scenario? Your worst case scenario is going to be owning Apple for what would effectively be net 160 because you're paying $20,000 if you lost everything on the spread. But the trick is you wouldn't lose everything anyway. Currently, this spread is worth $20,000. So if you stop out at $10,000 after you put in $20,000, you'd only be in for 10, and then your worst case would be owning Apple for 150. And owning Apple for 150 when it's 175 now, that's not a big risk. That's a reward practically that you get to own Apple for 150. Learner says, THC runaway success. Still think there's a lot of room for it to expand. I have $12 put sell and a 10-20 bull call spread. Is that how ours is? What do we have on THC? Oh, it wouldn't be here. Oh dear. Okay, THC. Probably like the options opportunity portfolio one. 10%. That's pretty good. 110,000. Where were they? Is that what they were at? I swear they were only like at 8%. Anyway, our last review, I don't think they were at 10%. Let's see. THC, here it is. So he has the 10-20 spread, and we have the 12-20 spread, and he's got the $12 short puts. So, big picture question. At what level of P&L achieved do you recommend rolling and or taking profits on for similar positions? Well, look, everyone depends on what you think of the position. I have zero fear that THC is going to go back to 20. So it's really a question of saying, well, how much do we expect to make on this trade? Well, we spent 10 minus 6 is 4, minus 35, let's say, is $500. So it's a $500 spread or $500 cost, and we make 15 times 8, which is $12,000. So 11,500 profit is our max profit. Liquidating right now, it's 30 minus 21. That's 9 minus 1250 is 9,000 minus 1250 is 7,700. So 7,700 out of the potential 12,000. So it's going to make 50% more, or more than 50% more. It's going to make at least 50% more if I just sit on it. So the question is then, do I have a better, more sure way to make $7,500? Using $7,500 I could get by cashing this out. Do I have a better way to take that money and make more than 50% in 2 years? Do I feel more sure about it? And the answer in this case is no. That's silly. This is basically a sure thing. So I have no reason whatsoever to change this trade. The requirement on it is very low because this is so far out of the money. It's more than 50% out of the money for the short puts. The bull call spread is, none of it was tying up any cash. I only put 500 cash into the thing. So it's really a question of, if I cash it now for 7,500 net, do I have something better to do with $7,500 net that makes 50% in 2 years in a more sure manner than this one does? No. Therefore, I leave it. And that's what you do. Every month you ask yourself that question. You run the numbers on every position you have and say, do I have a better use of this net money if I cash it now than if I leave the trade alone? And I don't mean, by 10% or 2% or whatever. It's got to be really better. It's got to be clearly a better use of the money. Otherwise, why go through the hassle? Because you're going to have friction costs cashing it out. You're going to have broker's fees cashing it out. You're going to have fees going into the new trade. So you go fee, all to do what? To make 5% more? That's silly, right? You have to be able to make significantly more money with better, not even the same, but it should be a better level of certainty. Because if it's the same, then what are you really doing? Then you're just doing it for a couple of points. So, that's how you got to look at every position every month. There's no thing I say, I recommend this. You have to think of that position exactly and say, is this position worth keeping in my portfolio, or could I be doing something better? Brian says, when are you publishing on the Maven? I don't actually know. Eileen's dealing with that stuff. But the way we're doing it is, what we're doing with them is they're going to get our morning post, and they're going to get other selected items like that Eileen pulls from the authors at PhilStockWorld. And we're going to set up like a portfolio for them, like we do over at Seeking Alpha with the options opportunity portfolio. But that'll be a subscription thing over there. And we'll just see what kind of audience we can build. They in theory, are going to have access to a huge amount of traffic. So we shall see how it goes. But more importantly is, we'll see what they do leading up into their announcement to raise another round of funds and so on and so forth. Because that's the key. Are people going to think it's a good idea, or is it going to be dilutive and they're all going to run away from the thing? 3 says, dang, I got greedy. I didn't understand. Maybe just tap. Huge drop today. Just like, all right, man. You freaking are you even a regular member? Because I don't just like instantly analyze things. When you ask something, sometimes you ask, and it's like a stock we're following, so I can quickly tell you all about it. But this is a big, big company, and is this it? Are we in the right place? Hang on. Let me close this window. Yeah. So Molson Coors, 11. Wait, this is annual, right? Yeah, $11 billion in business because they merged with somebody or whatever they did. They were doing $4 billion. They jumped to $11 billion. It didn't help their profit, though. Their income went down. They were doing better. They were making more money when they had less business. But that's, part of the merger stuff. So bottom line is, what do we expect to happen? So an optimist would say, I think that if they could make if they could drop $2 billion to the bottom line on $5 billion in sales, which is 40%, then 40% of $11 billion is more like $4 billion, and then they're probably undervalued. That's the logic to people who are bullish on them. But the reality, which slaps you in the face, is that they've got a $13 billion valuation, and their PE is up around 10. That's not terrible, though. So, and again, that's all I can tell you, though, because frankly, okay, let's see what they have. They're disappointing first quarter. Like I said, I don't follow these guys at all. I'm not terribly interested in the beer companies. I don't think they're going to be helped by legalized pot either. I'm not sure. I don't think stone people drink a lot of beer. Adjusted earnings per share checked in at 48 cents a share. Far short of analyst expectations of 80 cents. Wow, they expected 80? Am I crazy? Is this not a really cheap stock? 62. No, it's not that cheap. Okay. Yeah, so 40 cents a share. If you multiply 40 cents a share times 4, it's $1.60. Then they're in trouble. So there's a big disconnect. So see, that doesn't mean you have to check into it. There's a huge disconnect between this market cap, which may have something to do with the fact that they're an ADR, but this market cap versus what the financials show versus this dollar amount versus their earnings per share, it doesn't add up. And when things don't add up, you don't play it. It's the numbers are all over the place. So that may be another reason I don't follow them, frankly, because if I see when I see crap like this, I'm like, oh God, it's like who wants to pay attention to this kind of stuff if you can't figure out what they're doing? So they have a number of factors contributed worse than expected. Top line suffered due to financial royalty volumes, negative global mix, reversal of indirect tax provisions in Europe. See, they have so many weird international problems. Lastly, the brewer's U.S. sale to wholesalers was down 6.7%. The company undershipped product compared to the prior year. Why would they undership? What's going on? Regional blah, blah, blah. Okay, so there's your answer. Who knows? There's no clear anything on that thing. All right, where were we? Brendan says, is FNSR still a supplier to Apple? As far as I know, they are. Could they be a potential target? No, don't. But the point of what I was trying to make was Apple's not buying anybody. Why would they? They can already squeeze. See, here's the thing. Where's the advantage to Apple to buying FNSR? Because all it does is it locks them into their technology. Okay? Apple has a better PE ratio than FNSR, so it's not going to make them look better to buy it. But also, if you become the manufacturer of the components, then how do you squeeze the manufacturers? Apple can squeeze manufacturers literally to death. They have done it. They have put people out of business who were super happy about getting an Apple contract, and it turned out they bankrupted them or killed their business. Apple will make sure you don't make any money providing Apple your product, or you make as little money as possible. And they're going to hammer you, and they're going to go to your competitors and so on and so forth. If they own you, they can't do that. They are, if you've been in business, I've had many businesses in my life. You've been in business, you know that sometimes you have a big customer who you don't make any money on, but they keep the doors open. There's the cash flow from them. So, you'll take a big reliable player. If you're like any kind of B2B supplier, if you have one nice business that there are several reasons to take a guy on, even if you don't make any money. One of the reasons is prestige. This guy's my client, therefore, of course, you want to be my client. You go to the next guy, like, look, this guy's my client. So let's say it's Apple, right? FNSR goes to other people. Well, Apple thinks our components are good enough for their stuff. Boom. That helps them close other deals that are more profitable. Also, because Apple orders X amount of components, FNSR becomes a big shot, and they get a better price from their supplier, and that piggybacks where they get a lower price on the part from other people, and therefore, even though they're giving a no profit price to Apple, they give a profitable price to smaller companies, so they make nice money because Apple has driven down their cost of parts as well. So the companies that succeed in working with Apple are the ones that turn right back around to their own suppliers and push it, and then go to their customers also and say, hey, we can offer this super low pricing because we're already in this great deal with Apple. They don't say it like that, but that's the concept. And therefore, we can give you great prices, but not so great that we don't make any money. And that's how it works. And that's why, even though Apple is not even a profitable entity for the company, the fact that they order so much, and that these guys know that they can employ this many people, that it's worth it for them to have another production line open because they've got this customer they can count on, so on and so forth. But that's also why when Apple takes it away, it can kill a company, because they make all these commitments, they set all these prices, and they're all based on something that just one company leaving. Just if Apple leaves, it all falls apart, and you cannot replace Apple. No one is that big. So it's a hugely double-edged sword that's very, very dangerous game to play. I remember when I was in this real estate data company, and we signed up this gigantic company, and the company itself was probably 20% of the state. But since we only had half the state, they became like half of our business for a while. So we had to hire people just to take care of them. We had to get a new office just to take care of them. And we had to train people just to take care of them. And God forbid they got pissed off and left us. They could have bankrupted us. One new customer that was a huge win for us could have killed us. And then once we were comfortable with them, I could not even sleep until I knocked their business down to 1/3 of our business from half our business. And the happiest day of my life was when I pushed them to below 25% of our business, because it's horrible. It is horrible to have a gigantic customer like that be so much of your business. And so when you look at, when you say, is Apple still a customer? That's the problem. If they start not being a customer, it's not just the Apple business they lose; it's a leverage they have over their suppliers, and the pricing structure that they have, and so on and so forth. And then they have to lay people off and close things down. So I love FNSR. I've been banging the table on these guys for a while, but I'm just saying that can't be your only reason for getting somebody. But as far as I know, they're very tight with Apple, and that business isn't going away. And that's what you got to do, though. You have to look closely at their competitors and say, can anybody outbid these guys? You know, what does Apple need from them? What are they supplying to Apple? And can somebody do it better? And as soon as you see somebody on the horizon who might be able to outbid it, then either Apple's going to switch because they're going to do what's best for Apple, or Apple's going to put more pressure on FSR and pricing. So, you know, that's what you always have to look for. You have to be very wary when you have companies like this that you know that you've got it covered. But I still like them at this price. So, you know, I mean, we already talked. We already took aggressive positions on these guys. But as to Target, that's what we were saying. No, they're not going to be a takeover target by Apple, because then Apple can't play the game they play, which is to kill the suppliers and get cheap stuff. All right. 3 says, sorry and thank you, yes, paid member. Okay. Okay. Blah, 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 blah. All right, let's see. Brian says, instead of buying TAP, buy Mo. Yeah, we love Mo. Mo we just added as a, I think it was a top trade, wasn't it? Who knows? Wait a minute. Let's see. Top trade. PhilStockWorld. Oh, top trades. Look at that. It's right here. Probably not updated. There you go. We had a Disney, Gilead. That didn't work out so well. GIS. Wow. Another bad one. LB. Wow. Not a good month so far. What is this? April. Wow. April was not a good month. In April, our top trades have been LB, not doing well. General Foods, not doing well. Gilead, not doing well. And Disney, flat. So flat's our best trade for April. It's a good thing we wait 6 months to do the reviews on these things, because these are not pretty starts. But no, we didn't do Mo. I'm surprised. I think maybe we just sold the puts on MO, or did we take the whole spread? I don't remember. We had an SQQ hedge here. We have WBA. Those guys are doing good. Sonic and CBI. I don't think CBI is doing well. Oh, silly me. Wrong window. Ugh. CBI. Oh, CBI is popping. Nice. Okay, so CBI was a good one. And Sonic. Where's the chart for Sonic? I don't know what happened to those guys. So, see, it's a problem with top trades. We don't have a portfolio, so I forget what they have. SONC. Boy, I like that Apple trade. Definitely want to do that. Nope, Sonic has not been a winner, have they? Oh, well, actually, though, it's all the way back in March already, isn't it? March 27th. So, March 27th. Oh, they are. They're up since then. All right, so that's not such a terrible pick. And what do we got here? HBI, not so good, from March 15th. Just a little bit below where it was. UCTT. All right, they're not really going anywhere, but like them. IMAX. IMAX, weirdly, is not doing well. WPM again, like them. CHL, anytime it's below 50, it's a good company. I like CHL a lot. That is a nice company to own, and that's still viable. This was March 8th, and they're only up about $1 something from where we bought them. I like that. Anyway, MO not a top trade, but we totally love them, and we just added them, but I don't remember what it was. I don't think it's going to even show. It's not even going to show up yet in the long-term portfolio. I haven't done the updates yet. Let's see. Anything happening in the market? The Nasdaq's positive. Oh, Fed. Good point. Wow, good one. Thanks, Rich. Gotta look at the Fed. We forgot about those guys. They're going to release their thingy in a few minutes. So let's do that. FOMC meeting. Oh, God, I have to go to a show tonight. All right, so hopefully in about 10 minutes, we're going to see this thing, and we will get a statement from them. going to do a whole thingy on it. I'm just going to find out what's going on. So let's take a look at the Wall Street Journal. Is usually good for telling you what changed. There. Oh, that's going to hold China Telecom down. Trump administration considering restricting Chinese companies' ability to sell telecom equipment in the. Oh, that doesn't affect China Telecom actually. Oh no, Cobb is leaving Trump's legal team. Oh dear. Yeah. He's got no one left. Fed to focus on rising inflation, but likely to stand pat on rates. So up to the last possible second, people are saying the Fed will stand pat. I believe they are going to raise rates. Ugh. Are you kidding me? This is Jackie's account. That's why. Damn it. I'm not signing. I'm going to have to look at my other computer for the actual articles. Oh, Southwest had a cracked window. They had to divert a plane. Oh man, that's not good. That's 2 and 2. That's 2 in 1 week. The other one's worse, but all right, nothing too exciting going on ahead of the Fed. Let's see what the charts look like. If the Fed tightens, we're going to probably make new lows. Nothing very outstanding. The dollar's way up. The dollar, now see, there's an interesting play. At 92.50, 92.48 at the moment, 92.50 is a good shorting line for the dollar because if the Fed doesn't raise rates, the dollar will get weaker and drop back quite a bit. And meanwhile, if you stop out over 92.50, there's very little to lose. So that's an interesting way to play it. So of all the possible ways to play the Fed, that would be the most interesting, I think. How are we doing? Up 4 minutes. All right, we'll see what happens. So my only trade idea would be shorting the dollar in case they don't raise rates. If they do raise, I'm sorry, no wait. Yes, if they do raise rates, the dollar will get stronger. So the point is, that's what you want to hear, is whether they do or do not. So get out of the trade if it goes over 50, 92.50, or if the Fed does not raise rates. They raise rates. I'm sorry, if the Fed, if the Fed raises rates, which you're betting against, then the dollar will go up. I believe the Fed will raise rates. I'm not keen on the trade, but as far as the risk-reward scenario, it's pretty good because it's right on that 92.50 line. It's going to be hard to cross. So, but nothing thrilling about it. Just if you're going to do something, that's the way I would play it. But again, I'd be betting against what I think is going to happen. I think they're going to raise rates. And I really don't understand how nobody else thinks that. So it'll be interesting, and it'll be in a 3-minute time frame. So let's see. So my logic is, where's this thing? Oh, here. Oh. They've got 3 hikes to make this year. I don't see how they won't do 3 hikes. If they don't do it now, they only have 5 meetings left. And then they have to raise rates 3 out of 5 meetings. It's hard to do it in the summer because everybody's away and it's, and it can really whack out the market. June they could do it probably. September, by the end of September they could be done. November, you're getting to the holidays there, so it's not good. And then December, forget it. I mean, they hopefully learned their lesson last time they hiked in December, tanked the market. So let's say December's out, and that and the middle of July is out also. Well, I'm sorry, August 1st, the middle of the summer is out. So if those two are out, and you don't do it now, that means you have to raise rates June, September, and November. And they don't want to be in the position where they have to do anything. But by raising the rate now, if anything goes wrong, in 1 month, basically 1 month and another week, or a month and 10 days, they are going to be able to say, oops, we are reversing the last rate decision, or the last rate had a more of an effect than we anticipated, so we won't be hiking rates again for the, until, they can say at that point, they can say, we won't hike rates again until coming into November because we're worried about this and that. So if they do hike now and they get a bad reaction, they'll be able to deal with it also. So we'll see, but I can't believe they're not going to hike rates. So I'm going to put the volume on the TV for a minute and see what it says.
That's a big move up. And it's a big move up in the context of growth and inflation that frankly haven't shown very much. I know the forecasts are going to show more in the future, but until that's actually evident in the data, 2.5% funds rate.
I don't know who this guy is. All right.
It's pretty aggressive. And so we say that that's going to adopt more cautious approach.
Doing the same thing I am. He's basically just talk until the decision comes out, then comment on it. That's pretty much the drill. Oh, look at that. They got 5 guys lined up.
In terms of the Fed, the markets where they stand ahead of this decision, the 2-year yield is at 2.51%, the 10-year yield at 2.97%.
Here it is. Dun, dun. Unchanged. I'm wrong. There goes the dollar. Watch. Oh, no, it's at 50.05. Okay, now I like the short. Hang on. DX. So this is wrong. Oh, look, it wasn't actually there. Oh, wait. It's going higher. I'll take it. Oh, yes. All right, so I got to fill at 92.51. And we'll see what happens. So that's good for the markets. It's boosting the markets, and you could make a positive market play, but I like the weak dollar play better. Because look, if they're not raising rates, it's all relative. It's relative to all the other currencies and what they're doing. So the dollar has been on a good run. The Fed's not raising rates. Therefore, oh, here you go. See, therefore, dollar weakness. It's not complicated. You just have to understand the relationships from one thing to another. And we're not going to be greedy because now we're going to set the stop at 92.40, let's say, because it's a nice $100 gain right away. Hopefully get down around here to 26. Let's say, oh, there's 40 though. I don't want to blow a $100 gain. Nope. There, boom. So 110 bucks in 10 seconds. Fine. That's how you play the futures. We thought about what was happening and what was likely to happen. Make some quick money, get in, get out. So now the next thing I would look at is say the indexes are probably going to run up, especially if the dollar keeps going down. Plus, get back to like the commodities also can have a nice run back up. So who's good for a run? Well, we know natural gas. Gold. Oh, gold. I said earlier to the guys that I like gold down here. Brent coming off the floor, oil coming off the floor. Brent just moved less than oil. Ah, shoot. Oh, let's see. Ooh, 6,700. That's a good line on the NASDAQ. I don't see how this is going to make all of tech. Gosh, shoot, I could have held up for another 10 cents. Look at that. Now it's slamming down. So, you want to see who's going to respond to the weaker dollar, and it's going to be everybody, the commodities and the oil and so on and so forth. Coffee's closed, so you can't do anything with that. I think if the dollar keeps going down, which it is, I think gold is lagging right now. So let's do a YG. So now we're going to take a look at gold. Dollar is there, and gold YG. Yeah, that's not what it says. Oh, that's weird. I thought it was at 1304. It's not. It's already at 1308. Where's this line? Ooh, it's like the chart's not showing the movement. That's a shame. All right, can't play that because it can't. It does some. It's not jiving. But I don't see any sort of. Oh, wait, is that it? Oh, look, it's popped up there. That's why it gapped up to this spot right there. There's just that little white little piece of something. That's the gap up. So it just happened to come right at the rollover minute or something like that. So there's no line that you can see. It just suddenly appears way higher. That's a shame. Maybe over 13.10. Look at this. I got out way too early. If the dollar keeps plunging like that, then 13.10 will become the next spot you want to take along. But I think this is an overreaction on the dollar. I said it would settle. I said 25 would be about where it would hopefully get to. But if it goes significantly below, if it gets below that 20 line, that's some serious sudden weakness in the dollar for whatever reason. So now we're at 24 on the Dow. There's another line that you can play for bullishness. But again, the dollar stopped going down, so I think that's about it for the move, I believe, at the moment. All right, so let's see if we can read the actual statement and see what they have to say for themselves. Oh, I forgot about these guys. All right. Shh. There's no press conference. All right. Today, May 2nd. Yes, correct. Okay. Indicates labor market continued to strengthen. Economic activity rising moderate. Job gains strong. Unemployment rate low. Recent data suggests household spending moderated from strong. There you go. That's what they're hanging their hat on. Household spending moderated. So household spending dropped from the fourth quarter pace. So that's not what the Fed wants to see. That's one problem. While business fixed investment continues to grow strongly, on a 12-month basis, overall inflation in terms of food and energy moved close to the 2%. They say they don't think it's at 2% yet. I'm pretty sure it is. Market-based measures of inflation remain low. Survey-based measures longer term are little changed. All right, consistent with the mandate, then in that case, they're not going to raise rates because they say they're not at their inflation target, and what was the other thing that we looked at? And the household spending slowed down, right? So consistent, blah, 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 2% objective. The rates are going to stay 1.5 to 1 3/4. The chance of monetary policy remains accommodative, supporting labor market conditions and a sustained return to 2% inflation. So basically, they're not going to raise the rates until they actually get, in hindsight, not in Not in like today and this week we saw obvious numbers that show 2% inflation. They are basically saying we've got to have these things booked before the meeting and have a fairly good idea that this inflation is here to stay. So that's definitely going to push them off at least until June and maybe all the way through the summer. It might take them all summer to figure this out. So that is very interesting. That's way more dovish than I thought they were going to be under Powell. So where are we at? Yep. Oh, wow. That's a nice kick up over there. All right, so now we're back. Now we're going to be back to watching our lines and seeing if those bounce lines stick and what happens. But that's it for the Fed. No fun there. Why is RTI going up strong dollar? Russell companies love a strong dollar. That's what they do. They're American companies, much more so than the other companies. For the S&P 500, more than 50% of their business is done overseas. So they're collecting lots and lots of foreign dollars. So a strong dollar is not good for them. They're collecting foreign currency as payment. They don't want a dollar to be too strong. It's not good for their trade. On the other hand, though, Russell companies don't give a crap. They have 70, 80% of their business in the United States, and they collect dollars, and they pay people in dollars, and everything's in dollars for them. So those companies like a strong dollar, specifically. How do you ask a question, says Mike Yargo. Well, apparently, do it like that, except ask the actual question. Ben Mike says, what about UYM? What about UYM? What have they been up to? Let's see. UYM. So you are looking at what, the basic materials to just play them? So first of all, what's in the basic materials ETF? What are considered basic materials? What are they doing? They correspond to the Dow Jones Basic Materials SM Index. Should have blah blah blah. So they just hold more index. It's an ETF of other ETFs. And they have Monsanto, and for some reason they have Praxair. I don't know what that's about. They have DuPont. 20% of their portfolio is DuPont. That's interesting. What a weird little thing. UYM. There you go. So anyway, it's very thinly traded. Nobody's trading this thing. There's just, you see gappy, weird thing like that. I don't know. I couldn't tell you. I don't know for sure. You know, if you're gonna bet basic materials, you're basically betting on housing. You know, you're betting on a resurgence in housing and construction and so on and so forth. Ooh, what did Hub do today? That's what I'm interested in. So the answer for that is, you know, you're basically betting on a construction thing. And I don't know that I would make that bet, frankly. I'm not sure how sustainable it is. So Hovnanian had their earnings today. They sucked, but they're holding on to $2. And I love Hovnanian. See, if I was going to make a housing bet, this would be my housing bet. And I'll show you a cool way to play them. The long term, we keep waiting for the longer stock options to come out on those guys. But I like Hovnanian. Where's their thing, though? And it's the same trade, because but instead of just betting on materials, you're betting on the people who use the materials to build stuff, the builders. So let's see if we can see their numbers. Hovnanian, it wasn't earnings. I'm sorry, they missed a bond payment. Apparently, it's just a negotiating strategy. Trump would be very proud. They agreed to default on some of their debt in exchange for financing. And it's very complicated, but the guys who are refinancing them wanted them to default on the bonds that they have, and it's all a complicated negotiating strategy. But I was thinking like they would be lower and that they'd be easier to pick up, because I don't think they're really going to go back down. I mean, if that didn't drive them down, I'm not sure what will. the bottom line for Hovnavian, like any builder, they're going to be leveraged up the butt. And in this case, they're doing $2.5 billion in revenue. They're losing money. Okay, although they paid this huge tax bill that there was back taxes owed. So if they hadn't paid that, they'd barely be losing any money. Balance sheet wise, I think they're pretty healthy. We'll see. I mean, they'll have a lot of debt, but the point is they have cash. 400 blah 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 million in cash. Do quarterly. See how bad it went. All right, 285 million in cash. $1 billion in home inventory, which is real inventory, but somebody's got to buy the homes. Long-term debt 1.6 billion is kind of in line with where they usually are. So all in all, they're okay. The way you play the builders is you hang on. You have to ride out a builder until they get to a profitable cycle, and then you cash them in. Ooh, look at that! Oh man, did I get out early? Oh, now I'm upset. Could have been $500. All right. So for Hovnavian, HOV, they don't have very long options, but you can sell the $2 puts for 35 cents, and that nets you in for 165. And then you can buy the $1 calls for $1.10, and then you can sell the $2 calls for 35, 40, let's say 40, and that's going to net you in for 70 cents on the dollar spread less 35. So you're actually in for 35 cents on the dollar spread. And your bet there is that if Hovnavian does hold $2 into November, you will make a buck. You'll make 65 cents. It's like almost 200% back. The worst case scenario is you own them for 225 and I'm sorry, 235. Wait, yes, because it's net 35. You own them for net 235, which is fine because again, it's a question if you want to build into a serious position. So let's say, since you can triple your money, let's say you start with $1,500 as a commitment. So you basically sell 15 of these contracts, and you'll pick up, I don't know how that works. 15 times 35 is 350, and half of 350 is 175. So that's what, 442, something like that. So, 15 contracts, 1,500 gives you a 445. So let's say $450 credit here, and then you take the spread and you do 15 of those. 15 of those at net. What did we say the number was? 110 minus 40 is 90. No, it isn't. We're only talking about 70. Sorry, 70. So that's going to be 15 times 7. 70 is going to be 2/3 of that. It's about 1,000. So 1,000 minus 450. So your net entry is 550 on a $750. I'm sorry, on a $1,500 potential spread. Yeah, that makes sense. So basically, you lay out 550. This is for the 1-2 spread. You're laying out 550 for the 1-2 spread with the short 2 puts, and the potential payout is $1,500 on that. And if it doesn't go well, because you get, 15 contracts we're talking about, and if it doesn't go well, the worst thing that happens to you is you get assigned $1,500 at $2 plus the 550 you spent. So that's about 2.25. So you basically can end up with 15 and 2.25, so 3,000. So your worst case is you own $3,000 worth of Hovnavian 1,500 shares at about $2 a piece. Your best case is you pick up $1,000 profit. And you think that's a bad risk reward, but they're not going to zero. So it's not like they're going to go bankrupt. They're just going to either be above or below $2. If they're above $2, you win. If they're below $2, you lose, but you still own the stock, and then you can sell more calls and turn it into something. So I like that better. So the short answer is I like that better than UYM if you want to bet on materials, because you're basically betting on a pickup in housing and such. So CNBC, the May Fed meeting, here's what changed in the statement. Oh, thanks. I like that. I can't copy it, but I like it. Oh, wait. Maybe I need to do this. CNBC.com. Control C and go over there, and the Wall Street Journal is useless. And let's see how this works out. All right. Thank you to, who was that? Brian. Appreciate it. All right. So what have they changed? Job gains strong on average. That's a weird thing to add, right? I guess because there was a month where we had bad job gains where it went way down. Recent data suggests growth. Wow, it's strange to see what they decide to change. Why would they take out rates? Recent data suggested the growth of household spending, and business fixed investment. That's interesting to take that out. They move business fixed. So that growth. How about the recent data suggests a growth of household spending moderated. I said that was very important from the fourth quarter, from its strong fourth quarter pace, while business fixed investment continues to grow strong. So they're saying, again, that's the whole thing. I see they wanted to disassociate the two because before they were both looking good, and now only business fixed investment. So if we lose business fixed investment, that's a bad sign that might keep the Fed from raising rates. On a 12-month basis, both inflation, food and energy have moved close to 2%, as opposed to continued to run below. That is a flip-flop. Frankly, they're basically saying we're right on the cusp there of hitting 2%. It's not bullish overall. That little change right there is less bullish than it sounds. It's less bearish than it sounds. Market-based measures of inflation compensation remain low, have increased. So they've given up on that. So they're giving up on that, actually continuing to increase. Committee seeks to foster maximum employment and price stability. Economic outlook has strengthened in recent months. They're saying that hasn't happened, which is again why they didn't raise rates. And they expect blah-de-blah. Inflation on a 12-month basis expected to move up in coming months. So they're basically saying that inflation is right at where they want to be, right at it. But they're not going to raise the rates until it goes a teeny bit over, basically. It's interesting. So on the whole, though, it's not really market bullish because they are going to raise rates. They're just kind of waiting a little bit to make sure that inflation is really over 2% and isn't going to go run back the other way. They decided to maintain the target rate at 1/2 to 1 3/4%. Wow. Okay, so that was good because reading that with these annotations is helpful. It's not that bullish. They're still being a little bit. They're still going to raise rates. They're telling you that as clearly as they can. So things are moderated now. The dollar is. I wouldn't say it's going to come flying back. This was the people who were betting on a tightening, like me. I thought it was going to tighten, but that was a good run. And like I said, we're done with that. I don't mind making a quick $100 and being out, but it does suck because I could have done better. Could have done a lot better. Because we started at 50, so every dime was $100. Yeah, it would have been $500. Oh well. And now things are calming down because, as I said, when you read it more closely, you see that they're not being all that easy. They're just saying this is what the situation is at the moment. All right, that was good. I'm glad we had that. We'll check in with our portfolio, see how they're doing, and then we will be out of here. I'm going to see a show in New York City. Seeing some weird production of Sweeney Todd. I have no idea what it is, what the deal is. It's like a dinner theater-y sort of thing in the Village. All right, so options opportunity portfolio. All right, now it's at 10%. That's probably right about where it was when we did the review. There've been no changes. I haven't done all the things we talked about haven't been done yet. So possibly, well, maybe we improved things, maybe we didn't. I wouldn't want to bet on it either way. But we're really well balanced there. Butterfly portfolio, 8%, really good for the butterfly, considering it's only 2 positions. I don't know what else we can do. I guess we could add more positions, but like I said, you don't need to. That's the funny thing. We're only 4 months in and we're up 8%. So if we continue at this pace, we'll be at 24% by the end of the year. The options opportunity is about 10%, so that's going to be up 40% by the end of the year. No, wait, 30% by the end of the year. If we continue at this pace, we will be up 24%. So that's for the butterfly portfolio. That's all we want to do. But we won't continue at this pace because if we just add 2 more per quarter, as long as they all work out as nicely as these are working out, we will accelerate that amount. These will all accelerate. That's how it works. You guys don't remember because the butterfly portfolio was up 100 and something percent and keeping pace with all of our portfolios in the last cycle. But we built it the same way. It's like basically once a quarter we added a position until we had a dozen positions, and then we were like, good, that's all we need. Because when you have a dozen butterfly positions that are all generating a nice monthly income using the strategy we use, you don't need anything else to make 40%. That's it. We did the short. Oh wait, no. So that's it. And then we got the money talk portfolio we talked about. That we can't change that unless we're on the show. So we're just watching for a portfolio we don't touch though. It does really well. It's up 70%. But that's all the way goes all the way back to September. So this one had another quarter to build itself up. So there's a big advantage there. The long-term portfolio, stunningly well, 17.7%. And again, just tripled, 3 times that number is where we're going to be at the end of the year at this pace. So you're going to be talking about 50%, which is way over our target. And especially because the short-term portfolio is up 85%, which in theory, the short-term portfolio is down when the long-term portfolio is up. But because we've had really good timing with our in and outs on our hedges, we've actually turned them into little money machines and we've made us quite a lot of money. At the moment, they're costing us money. So the whole portfolio, the value of the actual positions here is minus $3,000, but we've already cashed out. We've cashed out 100. Well, we've cashed out an offsetting like $90,000. I'm sorry, it's -8. So we've cashed out an offsetting $93,000 in profits, and that leaves us with $185,000 total, of which more of it is cashed in our total, because the value of the positions we have is negative. But the negative is negative because we have this hedge that's negative. You know a hedge is going to be negative if the market hasn't crashed. The DXDs are negative. Also kind of silly because they're in the money. And that's the other thing. This is a spread that cost us, 60 cents, and it's 80 cents in the money, yet it's showing, well, it's not showing a loss. I'm sorry. It's 80 cents in the money. So it's actually a profitable spread. TZA, we only have the short puts. We never added back on the TZAs. And these May calls are going to expire, and then we're going to have to sell some more calls for against SQQQ. But that's fine too. I don't have any real reason to change it or do anything. So all the portfolios are humming along at really, a really good pace. For brand new portfolios, we don't usually have such a positive performance this early on. Our system is based on selling a lot of premium, and over time the premium erodes. But we have been nailing a lot of these trades. So we're getting some really early first quarter results that are surprisingly good. All right, well, it's not so much first quarter anymore. It's at month 5 now, right? This is May. So we're actually 4 months into the project. So it's a little bit more than first quarter. But still, like I said, 3 times more than what we're at now is where we should be by the end of the year if we keep a good pace. Not the short-term portfolio, though. I doubt that very much, because the bigger the long-term portfolio gets, the more hedgy we have to be in the short-term portfolio. As it stood, especially this, where we really want in the short-term portfolio is because right at the beginning of the cycle, we didn't have a big commitment. We started out with more hedges because we didn't like the market coming in. So we started out with a lot of hedges, and we had more hedges than we did positions. So when this was happening in January, we were layering up our, here was the logic. We started the year January 2nd, January 3rd with the portfolios. We put a watch list up, but we weren't hitting it because we didn't like that everything got more expensive every day. But as things got more and more expensive every day, my logic was, well, we're eventually going to want to hedge something. So we kept adding hedges all the way to the top. Then when it came down, we had all these incredibly profitable hedges, but we didn't have any positions to cover. So we cashed them out. So we made all the money we would have made offsetting a collapse in our long positions, but we didn't have any long positions. Then, because we had the nice crash and we made a ton of money on our hedges, we started buying and buying and buying. We got aggressive and bought a lot of positions in early February, and we bought even on the way up here. And since then, we're flat, but that's fine because flat works for us in the long-term portfolio because we're selling a lot of premium. And then when this happened, we cashed out the short-term portfolio again because we kind of stopped around the 200-day moving average, and we were like, that seems pretty good. And here we are again. So that's a rundown of our year. But it's been totally great so far. We'll see how it keeps up. Same for a hedge fund. Hedge fund's off to a very nice start also, and that really just started trading in January. So it's just been a good market for the style that we have, which is when the market is high, we start building up our hedges. When the market is low, we start buying positions. When the market is high, we build up our hedges again. When the market is low, we sell our hedges that we made money on, buy some more positions with the money we made. It's not complicated. And this range, by the way, look at this stuff. This range is squeezing. See that top line and see this bottom line, which is basically the 200 DMA is the bottom line. These lines are squeezing and converging, and in about this amount of time, which is a month, right? In about another bar that long, this will go to here, and this will go to here, and this will go like this and get very, 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 very tight in that range. And then here on early June, it's going to pop like it got shot out of a gun, up or down. I don't know which. Depends on the news. And if the news is Donald Trump is indicted, then it will probably be down. No matter how much you like that idea, it's still going to not be a market positive to have the president of the United States taken out of the White House in handcuffs. That won't happen. But, you can end up being in a long, protracted Watergate type, year and a half of hearings. Because Trump won't resign. He'll go down with the ship. Nixon resigned. As much as he was a crook, he was a patriotic crook. and he loved this country more than he loved money, Nixon. Trump does not love this country more than he loves money or himself. So he will take us all down with him if it happens. But anyway, this pattern, until you see it violated, is happening. And what does that mean? That means as long as we're in this little range around here, and that, especially as the range starts narrowing, these guys are going to pull together, and then they're going to resolve. They'll have to resolve up or down. And it's going to happen in roughly another 30 days. So in the meantime, though, also in line with our projections, we don't think anything's going to happen for a month. There won't be any kind of real resolution for a month. So what's our best move? Sell premium. We sell premium that expires before a month, so we sell May calls and May puts because we don't think the market's going to be up or down from here in May. We're still going to be in the same freaking place a month from now, or 3 weeks from now at expirations, whatever. So that's where we are. I mean, what are the global events? The trade war is a slow boil. You know, NAFTA is a slow boil. And these are all things that could go wrong and kill the market. Trump is also a slow boil, more or less. Those are our big issues. And then there's the economy, which is fine. And then, but then we're going to be right back talking about the Fed hike. Is this a meeting thing? On June 12th. So actually, it's interesting. This is when it's going to happen, June 12th, June 13th. This is when we're going to be right in that squeezy little tight little range. And then the Fed's going to say, now we have to raise rates. So it's going to be lots of fun. Have we touched on GIS? It's at a 52-week low. Well, like I said, it was a top trade. So Tim's asking that. Have we touched on GIS? It was a top trade. I'm not sure we ever put it in our portfolio, though. Let me see. Did we actually put it in the long-term portfolio? I'm thinking not, but you never know. Wait, it says 1. No, we did not. We never put it in the portfolio. So as to, it was a top trade, and so I'd have to look here to find out about that. Gilead, here it is, GIS. So what was our idea here? It was at 45, now it's at 42.50. Those should go in the long-term portfolio at the very least. Let's make this play official. That's my bad. I should have put this in the long-term portfolio. So I'll have to go back and put this thing in. So the bottom line is our target, we sold the 45 puts for $5. So that means our net entry is 40. That was our target price. We bought the 40 calls for $7.50 and the 52.50s for $2.20. So what's our net here? Our net is 15 minus 5 is 10, minus 45 is $5,500. So $5,500 on the spread. It's a $25,000 spread. So we spent $5,500 on a $25,000 spread. Worst case is we own 1,000 shares at 40 at 45 plus the 5,000 we spent, which is 50. So our net is really 50 if we allow this whole thing to go bankrupt and whatever. We're obviously not going to do that, but that's just the worst case. If we go back to GIS, oh no, see the index is already falling off. So as I said, it really isn't that it's not that bullish for the market. GIS. So since we have the 40, 50, 250 spread, so since we have the 40, 50, 250 spread, we have the 40 calls that are $5.50, let's say, and the 52.50s are $1.50. So what we want to do is take a look at, is it worth it to roll down? So for $5.50 to $6.90 is $1.40 to roll down $2.50. That's not that exciting. From $5.40 to $8.70, I'd say. $8.70, yeah, $8.70. That's $2.20 to roll down $5. Now I'm interested. So the way I would do it is I would just simply widen the spread, and it will cost 5 times. Let's say it will cost $1,000 to roll them down from the 40s to the 30. From the 35s to the 40s. I'm sorry, 30. From the 40s to the 35s. Sorry, from the 40s to the 35s. I'll get it eventually. It's worth it because we're only spending 560 to 860. We're only spending $3 in this case to roll down $5. It's not that bad, but we're going to make that money back. So I'm sorry, it's $3 times 20 is $6,000 in that case. Why did that seem so much cheaper when I said it the first time? Nope, but that's what it is. All right, whatever I said before was wrong, because the 40s are 550. These guys are 850, so you're talking about $3 to roll times 20 shares is $6,000. So we spend $6,000 to roll it. But now we have a wider spread, and what we can do with that wider spread is sell some short calls. So I wouldn't want to sell too many, but we have 20 longs. So we could sell 5 of the June 4250s. They're 120. So we can pick up $600 there. Now, let's assume that we pick up $600 every 45 days, not even 60 days, and we've got 600 days to sell. So that's like we have more than 10 chances, obviously more than 10, it's more like 15 chances to make $600. That'll pay us back $9,000. That's more than the whole spread we get paid back while we wait for the spread. So that's basically the kind of adjustment I would want to make on that one. And that's what happens. If a position goes our way, then we just take the money. And if a position goes against us, we improve the position, add a little bit more cash to it, and then figure out a way how to turn it into a little piggy bank for ourselves. That's the key to this thing. All right, you know, when life hands you whatever, you make whatever. I forget what the expression is. Lemons. When life gives you lemons, you make lemonade. That's basically what that is. It's like, okay, we like General Mills. Where is it? Can I? All right. Oh, they don't have it. Damn it. I was going to say, what are their divisions? Anyway, we like General Mills. There's nothing wrong with them. They're just down in the consumer sector. They didn't have exciting earnings, and people are running away from them. But that doesn't mean you can't own them for 20 years and generate an income. There's a lot of good, boring businesses that you can do this with. So, you know, we're happy to have it. It's nice to have a nice long-term position that every 2 months, basically, we turn around, we sell more calls. So that's going to be the fate of this position in the long-term portfolio. Oof. All right. So I'm about done. Any last questions before I go? GIS? Nope, that's not a question. We already did that. So take a quick look at the charts and see where things are. So sorry I got out of the dollar too soon, but you know the point was the logic of the trade was pretty simple, right? You read the Fed statement, you look at where the dollar is, and you say that's not what they wanted. That's not what the bulls wanted. The dollar bulls wanted the Fed to tighten. That makes the dollar stronger, tightening. They didn't tighten, therefore the dollar gets weaker because not for no reason, but because it's already up. Obviously, people were thinking they were going to tighten. So once again, though, we're getting weakness on a day that we should have strongness, and especially with Apple having such a strong day. I don't know where they're at now, but it's really not a very positive market. You know, I'm happy with the hedges that we have. I'm not looking to really add a lot more, but I'm also, unfortunately, I'm not willing. 5%. I mean, Jesus. It's a $900 billion company that gained $45 billion in valuation. Let's put that 5% in perspective, okay? Because 5% of Apple is all of Qualcomm, basically. So you're talking about, you know, they gained a Qualcomm in valuation. That's crazy. Even Tesla isn't worth $45 billion, is it? No, it can't be. That'd be stupid. Let's never say that it's not stupid, but what are they at now? Tesla. It says Tesla up here. Oh, there we go. Okay. $50 billion. All right. Well, okay, that's what Apple gained today. They gained a Tesla. And Tesla snuck up also, so they're a little bit more expensive. But But there's a difference with Apple though. They didn't really gain it because what happened is, as I mentioned in my article today, which I think is really important for everybody to read, as far as manipulation in the media and what you should trust and what you shouldn't trust. Apple was pushed relentlessly down with bad news, bad articles, bad press, blah, 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 on something that turned out not to be true at all. The iPhone X was like a disaster for the company, and they were going to report earnings that were going to show like, oh, we're going to have to abandon the iPhone X. It's a failed project. They had people say, we talked to the suppliers, and we talked to this guy, and we looked at the sales, and we ran the numbers, and we got the shipping reports. All of it, either they're completely incompetent or they're lying, because they were totally wrong. And if you follow these people and you listen to what they say about things and they're that wrong, you got to stop following them. They're giving you poison information. And it's not an excuse. I mean, I was very disappointed to see Forbes there, but I will tell you with Forbes, I know in Forbes that almost anybody these days can get something published in Forbes. It's so much easier than you think. And it's bad because, what happens with Forbes is you have to work your way in to be a writer. I mean, believe me, I've even looked at this process myself. But the thing is, there's no advantage to it unless you want to be a skis ball. But you go through their processes, you become a Forbes writer. By the way, I was a Forbes writer years ago. They kicked me off because I started a revolution at Forbes because people, the customers, not nobody in the editorial board was backing me up. But I'm writing my typical stuff, and every once in a while I mention something like, well, capitalism sucks because, and oh my God, their readers went insane. I literally caused their readers to have heart attacks. They had a board meeting about me. The whole board of Forbes had to meet about me with Steve Forbes and everything. So, and they decided, they didn't just kick me off as a writer. They redacted the articles I wrote and took them out of Forbes so that they would not be tainted with my communist rants. Because I said capitalism might not be so great. But they are called Forbes, a capitalist tool, and the people who read it don't want to hear anything else. It's amazing. I mean, they said, look, we're sorry, but we can't have you writing for the magazine. The readers are freaking out and threatening to cancel. They're like, we've never gotten a response like this where so many readers have written in saying, how could you have that guy in there? He's spouting socialism, communism, whatever. So that was my old experience writing for Forbes. I could still, though, they want me back now, but again, only if I behave, which is bullshit. But the process, as I said, I know a lot of people who've gone through it to write for Forbes. So many people can write for Forbes, and unfortunately, because it's so easy to write for Forbes and almost any other of these magazines, it's so easy to get yourself in these days because if you're willing to work for free or for cheap, they'll take it. It's not like the old days where you had to prove how special you were and prove your integrity and so on and so forth. No, now it's like if you're willing to work for cheap, they'll take it. And it's the same with all these magazines, unfortunately. And they get these guys, and as soon as you're in, then there's two things that happen. Some of the guys are in, they're just pure mercenaries. They always intended to do favors for their friends or sell out, to whoever bids the most to pump good articles and so on and so forth. Who was that guy? Tobin Smith. Tobin Smith got in big trouble he flat out was selling his services. I will talk up your company for $50,000. I was like, basically, he practically had a billboard up. But they're all doing it. And the guys who write at Seeking Alpha and people who write at Motley Fool, they're all doing it. They all have their hands out. Not every single one, but I mean, it's happening so often, it's disgusting. And so many articles are being written by company reps, or the facts are spun this way, or they write an article to promote this and promote that. It's horrible. But honestly, shame on the readers who think that they're going to get quality journalism for free. Somebody's got to make some money, and the people who make the money are the people who are taking the bribes and the people who are manipulating what you buy by telling you things that just flat out aren't true. And they're taking these names, which we talked about in the article today. They're taking Yahoo, Fortune, Forbes, Fox, well, who thought Fox wasn't? NPR, shame on them. USA Today, The Times in the UK, Newsweek, Value Walk. Value Walk, I'm shocked that Value Walk would put this in. Now, granted, I'll say though, to their defense, says KeyBank analyst is not really the same as putting an article out that specifically says, like NPR, slower than expected iPhone sales are likely to hurt Apple's bottom line, blah, blah, blah. That's different because they're saying it's a fact. These guys are saying, this KeyBank guy is saying this. But still, this is the difference. You know, because we won't run stuff that's not true unless it's as an example where we're saying, look what these guys are saying. But generally, you know, we won't, if we don't think something is true, we don't put it in PhilStockWorld. But that only works because we have a staff that knows how to read the stuff, and we red flag things that don't make sense or sound fishy. You know, and we'll still put stuff in. We put stuff in from Zero Hedge all the time, but it's from Zero Hedge. It's their opinion, blah, blah, blah. But we don't run main page articles that say things that aren't true. Because that's terrible. And certainly in chat all the time, I tell you about all this stuff that's bullshit. You got to have your eyes wide open in this stuff. And the problem is the public, because they won't pay these people enough to have to have the kind of analysts that you need to decide whether or not things are true or not. So the editors don't know that the writer is getting a kickback to write something positive or negative about a company with no facts backing it up, and they don't check facts. That's also frightening. I've written for so many magazines and websites over the years. They don't check facts. They never ask you where you got your information. That's insane. When I used to write for print, back in the days when there was print, but in the old days, we used to actually have papers, and they would put ink on paper. In the old ink and paper days, though, the editor would often call you up and say, hey, where are you getting this number from? I don't see it. He said, I was looking around. I don't see how you're getting that figure. And you had to justify to them how you got the figure, or they'd kill the article. Now it's easier to check, but nobody checks. And people just publish any old bullshit or just completely make things up because all these are wrong. They're fake. It's not true at all. Yet, day after day, week after week, this is all we heard. It's shocking. But it's shocking because it's a broken and it's a corrupt system. And the money that's made, follow the money. The money is made not by your freaking 1 penny per 1,000 eyeball advertising expense. That's not paying for these things. The money is made by manipulating your thoughts and your investing decisions to get you to buy things that aren't really that good and get you to sell things that aren't really that bad. And there are people who work that system because they make billions getting you to move in and out of stuff that you shouldn't be. And that's what you got to learn to cut through. And one of the ways to cut through it, though, is to learn how to be a good long-term buy and hold investor. Because, we don't change our positions much. We usually only once a month make adjustments to our positions, and even then, only a couple. I don't have the long-term. Well, wait. When was the long-term portfolio review? Couldn't have been long ago, right? It had to be. It was the expiration Friday, right? Was that last Friday? No, it had to be the one before. Not that Friday. Tuesday, Monday. That one, April 20th. Yeah, that sounds right. All right. 575. So, oh yeah, there you go. 575. And what's it at now? 588. $13,000 since the 20th. So in 10 days, made $13,000. Means making $1,000 a day. Market's going nowhere. Portfolio is making $1,000 a day, which is $200,000 a year, which is 40% pace, which is exactly what we said it was at, right? So it's and that's completely untouched. I have not made any of the adjustments. These exact positions, without being touched, have made $1,000 a day since we put this portfolio up. Now I'm just looking to see how many adjustments. One adjustment, two adjustments. It should be a part 2 somewhere. Three adjustments, 4 adjustments, 5 adjustments, 5. So 5 positions were adjusted in the portfolio. But even without making those adjustments, we made $13,000 more in 10 days. All right. It's not, you don't have to move in and out of stuff all the time. If you set your positions up and if you learn how to be the house, and I say it over and over and over again, you've got to learn to sell premium. It's got to be the whole purpose of your portfolio is to sell premium. When you look to buy a stock, and a lot of you guys, you ask me about stocks all the time, like TAP or Bud or this or that. I don't give a crap, even if it's a great stock, if they don't have good options to sell. If I can't see myself generating a good premium income from it, I don't want it. I want a portfolio full of stocks that I can collect a huge premium against. That's my business. It's like if I'm a landlord, if I'm a real estate retail, if I'm a residential real estate landlord, I like buildings that I can put people in because I know how to fill a building with people and make money. And I know how to run it, and I know how to take care of it, and I know how to create a steady income from doing that, okay? Now, you can go and again, I don't know, I do this stuff, well, I've done these things a million times in my life, so I don't know how everybody does it, but if you ever go to a commercial guy with a residential product, with a residential investment, they'll say, no, it's not my space. You go to a residential guy with a commercial investment, they'll say, no, it's not my space. I mean real professional guys, not your buddy who's got one building. I'm talking about like the guys who have like a whole business where they do stuff. They don't do this and that and the other thing. They don't develop land. The guy who builds buildings doesn't develop land. The guy who develops land doesn't build buildings. They stay in their lane because they know how to make money. They become an expert in that. Okay, your heart doctor doesn't do brain surgery on the side. Doesn't even do urology on the side. He doesn't even do feet on the side. Podiatry, whatever you call it. Okay, they're different guys. The problem with a lot of investors is you think that you can do every single thing. That you'll do a little of this and a little of that and a little of that, and you're that disease guy who got in trouble. He's a master of none, right? Not the master of any particular thing. And I'm trying to show you guys that this system, where you just concentrate on taking positions that let you sell premium, is going to make you money consistently year after year after year, 20%, 30%, 40% returns. Because you're selling risk to other people. And there are always people willing to take the risk, and there's always risk to sell, and it always expires worthless on expiration day. Doesn't matter if the stock goes up, down, or sideways, the risk premiums expire worthless. It's a fact. It's the only fact in the market. And if you just pick a stock that doesn't go bankrupt, so that you, why doesn't it go bankrupt? So you can keep selling the risk. If it does, as long as it never goes bankrupt, you will have a position. As long as you have a position, you will sell risk. And as long as you can keep selling risk, you will eventually pay for your stock. And as you can see from the ones we just looked at earlier, it doesn't take that long to pay for your stock. You know, what was it? It was one of the, whatever the dividend stock we looked at before was, you know, you're knocking off 1/3 or 1/2 of the value of the stock, the price of the stock in a couple of years. So 2 years later, you knock off all the rest of the cash. What does that mean effectively in a portfolio? You start out with a $50,000 block of cash. You buy this position. 2 years from now, you have $100,000. You have, no, I'm sorry, you still have the position, but you've gotten your $100,000 back. I'm not in 2 years, I'm sorry, in 4 years. So in 4 years, you buy another position with your $50,000. But meanwhile, the first position, which you bought for $50,000, is now still collecting $25,000 in cash. Meanwhile, your second position collects $25,000 in cash. So now your $50,000 cash and your position is collecting $50,000 in cash. So by 2 years after that, you can now buy another position. Then 2 years after that, you're collecting $75,000 against your 3 positions. $75,000 is more cash than you started with when you started with $50,000. And it grows and it grows and it grows. Because there's always people who are willing to rent your stock. Just like there's always people willing to rent an apartment building. If you build it, they will come. And this is all we're doing, is building solid long-term positions. This is not even the good part of our portfolio, and we're making 40%. This is the part where we're establishing our long-term positions so that they will make much more money than that. And as we demonstrated with the last long-term portfolio, we only went 4 years. In 4 years, we got to, it was over $1 million. So I mean, we made 200%. No, I'm sorry, we made 100% in 4 years. So we got a double or more than a double in 4 years. That's all we ran it for. And here we are starting again. It gets exponentially bigger. And that's the problem, though. It gets so big in 4 years that the money you're making is silly. And that's why we rebooted the portfolios, because you're not teaching anyone anything. We had a whole bunch of mature positions. We've gotten all of our cash back, and now we're just minting money. So it wasn't doing anyone any good educationally to just keep doing that. So we started from scratch again, and I'm trying to show you again, this is how it works. And 4 years from now, I'll frickin' do it again for the next bunch of people who need to learn this stuff. But this is not complicated. It's only complicated when you let yourself be shoved around by these jackasses who try to chase you in and out of positions. Imagine if you owned apartment buildings to rent out and you jumped in and out of them every time somebody wrote a bad article about the future of real estate. That would be insane. Yet people do it with stocks all the time, and it drives me nuts. I hate to see it happen. That's why I wrote that article today. All right, anyway, that's what I wanted to get across today from my article. So buy and hold, much more fun, much more profitable. Phil, I joined the webinar late. Did you talk about Gilead, new positions or adjustments? I talked about it in chat. We haven't really done anything yet. Going to give it a couple of days to settle out, but generally we're going to turn it into a spread that we like. We definitely like them, and they're ripe for for setting up a bull call spread and collecting money, that's what we want to do. That's what we always want to do. Did we look at the oil report? Oh, Dave, come on. I was done. Urgh. Fine. Petroleum status report. I don't think there's much to it, frankly. Oh, okay. Oh, look at that. We got a big pop here all of a sudden. My comment earlier was this today? Yeah. Control F, oil. Okay. So I said, look, we had a net build in oil, and RB is not. Our RB was not good either. So we had a build in oil and a build in gasoline, a huge build in oil, 6.2 million barrels. Build in gasoline, but a drop in distillate. So it's really all about the net, and the net is 4.3 plus 1.2. I'm sorry, not 4.3. 1.3 plus 1.2. So the net is only, 2.3, right? 2 will give you 5.9. 2.3 plus 1.2 is 3.5. So 3.5 million barrel net build. That's the thing to focus on. What's a net build? Because obviously, if they make more distillates, they're going to take it out of the oil stock, right? So it has to balance out. So it's the net build is 3.5 million barrels. That's still a decent net build, though. So net build in oil, RB was not good, but the draw in distillate shows there's demand for something. Diesel, aircraft fuel, something. For some reason, people want distillates. In fact, I was just talking to these people overseas who were looking to buy a bunch of distillates too. So, something's picking up on that end. Let's put it that way. It's probably diesel. Which might be more economic activity, more trucking, so on and so forth, which is generally, good for oil demand. So back to the report. Oh, I already had it up here. See, I meant to talk about it. So what we're going to do is look at the thing. So look, no change, refinery activity, no real change, not real big, no big change, no big change, no big change. So nothing going on over there. Net, almost a 5 million barrel net build. So other oils obviously went up. I can tell you without even looking, because we said 3.5 and it turns out to be 5. So immediately it has to be other oils. So other oils. So they're also sneaking in there. So there really was a pretty strong net build of 5 million barrels if you count the other oils. Exporting. Now, here's the worst thing. We exported another 200 million. So 1.4 million more barrels were exported this week than last week. So in addition to having a 5 million barrel build, we sent 1.5 million extra barrels out of the country. This is why the price of oil is going up and up and up. I mean, the price of gas is going up and up. We're shipping it out of the country. Huge amounts. 3.2 million barrels a day, 22.5 million barrels a week. We only consume 20 million barrels of total product a day. There's an entire day's production shipped out of the country, away from the U.S. consumers, who have to make up for that by paying more money. How much more money? Was $49, now $70. 40% more than last year. We're paying 40. See, Trump is so full of crap because this is such an obvious thing. We, the U.S. consumer, are paying 40% more money than last year for the same petroleum products because we're shipping it overseas. Because the U.S. companies here, the very, very tiny amount of people who make money on oil in this country, are shipping it overseas to create an artificial shortage here and collect more money overseas. That's what this game is about. It's really disgusting. Oil's up 40%. Gasoline is not up 40%. Gasoline's only up not even 20%. 15% gasoline's up. Although that's not hurting refiners. They had wonderful, the refiners made huge money. So don't worry about that. They don't need to raise their prices, but they are still trying to. They still are jacking them up, well past the $3 rate now. So it's really painful, and it's getting more. It's going to be a very painful summer for consumers, and that also is going to put brakes on the economy if it doesn't reverse. And it probably won't reverse because the Saudis, with the Aramco deal, are doing everything they possibly can to jack up the price of oil. So we'll see what happens. So meanwhile, major indexes going down, Russell going up, but the Russell will come down soon. So if these guys start failing these lines where they are now, 2650 failed already, 24,000, 6,700. If these fail, this is a great short, 1565 on the Russell. I don't know that they're going to fail though, because it's a weird sort of a day. But the dollar's coming back, so maybe. I like it. I like the Russell short. So 1565 with a tight stop above would be the way I'd go for the short. I tell you what, I'll make that trade just so we can watch it. Active trader, RTY. All right, so there's no good short for oil or gasoline or anything else, but this one is fun. I like that one too much not to do it. So very simply, below the 1565 line, that's a hard stop above 1565. But I think that if these guys come down a bit, then the Russell will start catching up. Although right now it's going the other way. Whoop. 1565 is right there. No, maybe not. Ooh, over. Yeah, one more here. Okay. So now the average is 156465. Tiny bit over, but see what happens. So that's what I mean by hard stop. I add one, and then I see what happens. I'm not going to jump right out after 2 seconds of being in a trade. But that's not good. Now he's going back up. So we don't want to see that. We really want to see this guy break below 24 to confirm that we're going to close down. But he's right on the cusp. Now the second I get down here, because here we go, right now. There we go. I've now lowered my basis, right? And I'm at 1565 now for a break even. Well, that's not probably accurate. I'm probably break even right about here. But the point is, I'm sorry, not lowered, wrong term. I raised my basis to a higher strike. So now I have a little bit more cushion than I had in the first one. So the only reason I added to the position to the short was so that I could then sell as soon as I get back in my range, and I have now a higher net entry than I would have had before. And you can't lose sight of that. If you're scaling in and you forget to scale out, you get stuck with a huge position that you didn't mean to have. You've got to remember to scale back out. So like I said, up 2409. See, I'm waiting for this. When he cracks, that's going to be a great sign for the Russell to start catching up. Because it's not as clear on this chart, but looking at this chart, you can clearly see the Russell has done nothing to come down. Everybody else is failing their pink lines. He's still up at his red line. And the drop from his pink line to his red line is huge. That's like 20 points. That's good for $1,000 on the Russell contracts. So it's like $50 a point on the Russell. So if these guys start failing these lines, that's my premise when we started, then this guy's going to start catching up. And if he starts catching up, that's going to be fantastic. So it's not, again, it goes back to the same thing every time. It's not a big risk, but it's potentially a huge reward. So we'll just see how that plays out into the close. But now that it's green, certainly you put a stop to make sure it doesn't go red. Make sure you take a profit off the table. Once you're green, make sure you get a profit off the table, and then you're going to be happy, right? It might be a big profit, it might be a little profit, but it isn't going to be a loss. And that is where we're going to wind this one up, all right? So we did look at the oil report. No more questions. Fantastic. Thank you for coming, everybody, and we'll do it again next week. All right. Hopefully the Russell comes out well. Take care.